Hi everyone, welcome back to Be Rich Podcast. This is Vinod here today. I'm recording in Elon's computer today, one of our editors. Since you guys like some background noise, I've asked the boys to continue working around me, and you can hear Anand in the background too. He's talking to someone too, so kind of gives an atmosphere of us sitting in a coffee shop or at least in a place which is more lively than inside my sound booth. I hope engaging for you guys. If anything, you can let me know in the comments below what you think. In the last podcast or the one previous, I had interacted with a few of the comments down on the podcast. Then I was alerted by my team that bots do operate on the comment section, and to avoid doing that, so I'm sorry for coming and commenting and reacting to your comments over there. You can find me on my Instagram, and you can message me on Instagram, and I'd love to interact with you guys, answer any questions you may have, or listen to your feedback about our podcast. So today what are we going to talk about? Today we're going to talk about analyzing stocks and shares, how it's done here in India, and how we need to do fundamental and technical analysis before we buy a share. I've done a similar video with Kesav on Money Pechu, which was in Tamil. So I thought I'd do something similar in English here because a lot of you have been asking for this. And this might be a little more expensive than what I did with Kesav, since it's just me talking and there's no Kesav here. So it might not be as entertaining as the Money Pechu one, but the content should be pretty solid here. So what is fundamental analysis? Fundamental analysis involves evaluating a company's overall health by studying its financial statements, management quality, industrial position, and economic conditions. So it's looking at the micro and the macro simultaneously and coming to an assessment if a company is worth investing into, if the shares are worth buying. Because we are value investors, we're not day traders, nor are we gamblers, nor do we do shorting and putting options. We are value investors. So that frame of mind is what I'm coming from. So remember this. So you might not be interested if you are a person who's into trading, into shorting the market. This kind of information, this kind of deep analysis may not be your cup of tea. But anyway, I hope you are around and you continue listening to this. Financial statements. What are the financial statements we look at? There's a couple of them. First one is the balance sheet. Then you have the income sheet and the cash flow statement. What financial statement? So in the financial statement, balance sheet. What does the balance sheet do? The balance sheet kind of provides a snapshot of company's assets, liabilities, and shareholders' equity. That's basically the money which has been put into the company to do the business, what assets has it generated, and what liabilities it has. This kind of gives an overall picture on where the company is right now. It's like the ECG of the company. Next, you have the income statement. The income statement shows the revenue, the expenses, and the profit and loss over a period. So it's like seeing the blood flow of the company. How is the blood flowing? Where is the money coming in from? Where is the revenues coming in from? How is it being generated? And expenses. Where is the money going to? And what are the kind of profits it's making and the kind of losses it's making? So it should ideally be the revenue should always be higher than the expenses. Profit should be higher than the losses. This is the income statement. The third one which we look at, the financial statement, is called the cash flow. This highlights how is the cash being generated in the company. And this generated cash, how is it being used in operations, in investments, in financial activities. So this is actually the actual cash which is coming into the company. How is it being generated and how are these cash being used in the company is what the cash flow statement lets you know. This is also very important for the simple reason it lets you know if there's cash, if the company is spewing cash, if it's able to generate income, which as an investor is a very important thing to look at. Once you've had a look at all this, then you start calculating some important ratios. And what are these important ratios you look and calculate? The first one is, of course, the very famous one, which is price to earnings. Price to earnings is PE. It's nothing but the market price divided by the earnings per share. This gives you the PE. And historically in India, a company which has around a PE of 15 is considered to be attractive buy. Anything 15 and below is considered a good margin of safety being there. Anything higher than 15, the margin of safety seems to get thinner and thinner, meaning there's very little chance of the share price going up and any growth in it. That has reached a point where the company is starting to become overvalued. Some people take this number up to 20. Me and Anand look at this number around at 15. The next ratio which we look at is called price to book. Price to book is what is the market price, the share price, what is being sold at, and book is the value according to the balance sheet per share what the value is after asset, liability, everything is calculated. What is the per value share according to the balance sheet? Usually, if the price to book is below 1, it's considered attractive buy. If the price to book is above 1, it's not considered to be an attractive buy. It might be overvalued. Price to book. Only we mainly look at it in banks because banks have their assets are mainly the deposits which the bank is holding. So the price to book gives a clear idea on what the value of the bank is. But in other companies such like Tata Motors or any other FMCG company, price to book really does not give any real doesn't help us really evaluate if the company is a good buy or not. The value of the PE, PB is high or low, it really doesn't help us. Debt to equity. Debt to equity is the amount of money the company owes to the amount of money it was invested with. This ratio is also important to see how much debt the company is carrying. This helps us understand if the company is debt laden and if it has too much debt and if it will not be able to pay it in the long run. Fourth one which we look at is called the return on equity. Return on equity is the amount of money which was invested in the company and what is the return that is giving per share to this equity. After this, we look at current ratio. Current ratio is nothing but taking the current assets of the company from the balance sheet and dividing it by, it is current assets divided by current liabilities. Current ratio is current assets divided by current liabilities. Current assets include cash and cash equivalents and accounts receivables and inventories and other assets that are expected to be converted into cash within 1 year. And liabilities is accounts payables and short-term debts and other obligations which are due within 1 year. So this tells you how liquid the company is, and if the number is usually looked upon as greater than 1, then it suggests the company's current assets and liabilities is in a better position to pay off short-term obligations. If the ratio is less than 1, it indicates the company might be facing some difficulties to pay it in the short term. So we always look at this to see how the current company is doing right now. Its current debts. Some of the long-term debts we don't need to pay immediately because the company has time to pay it down. But these short-term debts, the obligation should be met, and we don't want the and we don't want the company to default on these. So this is important to look at. The next one which we look at is called the profit margin, which is the margin of profit the company has, which is also an important evaluation to do before we decide to invest into a company. After all these kind of analysis, financial analysis is done, we move on to the next phase. Most people would say the next phase, most people like to do it first, then do the financial ratios. Me and Anand prefer doing the financial ratios first because if the numbers don't make sense, there's no point looking at it. Some other people take the other approach saying if only the macroeconomics makes sense, we should actually look at the numbers. So we always like working with numbers, me and Anand, because it keeps us mentally agile and keeps us practicing number crunching. So we like doing the number crunching even if it doesn't look like a company will invest into. Anyway, I digress. Getting back to the point, the next thing which we look at is called the business model or the competitive position. What is this? Competitive position entails understanding how the company makes its money, how is the industry placed, how is the company placed in the industry, how are the competitors doing, does it have any competitive edge, does it have a moat, as Warren Buffett says, what is a brand, does it have a strong recognition, does it have any proprietary technology, does it own any patents. These are all pluses for a company. So this is the next thing which we look at. After that, we start seeing the management quality. Who are the guys running this company? In India, mostly the big companies are family owned and family run. So we'll see who's this family, who's running it, the history of the family, then what is their education qualification, what is their credibility, what is the integrity, have there been any problems they've had with other companies. So we analysts may assess the track record of the top executives. If they are in India, we really don't see this analysis of top executives too much, and their strategic distance making and corporate governance practices, yes, we look at. But the track record we don't look at because most of these are family-run companies. The track record is usually within the same company, except for a company like ITC, which might be professionally run. So we look at the track record. Industrial analysis. Industry analysis is vital to understand how the industry is doing and how the company operates within the industry, including knowing how the industry's growth is, what are the key drivers and barriers for entry and competition in the industry. So in India, we have various industries and sectors. For example, IT is an industrial sector, pharma is another sector. So we look at how is it doing, Then we start looking at the macroeconomics, which is the GDP of the country. So how has the growth been in the country? Then we look at the interest rates. How is the RBI interest rate cycles going on right now? Are we on a high cycle? Are we in a low cycle? And how does it affect this investment, this sector, and this company? Then we see how does inflation numbers affect this company. Let's say it's an FMCG company. If the inflation rates are high, where is its product placed in the basket of inflation? How is it affected by petrol and oil prices is something which we analyze. Then we look at the overall employee levels in the country. How is the unemployment rates? How is the employment levels? It gives and how does it affect the company? These are another macroeconomic indicators. Then most important one is also political stability. Political stability is important because good governance is required for any industry or any company to thrive. I'm not talking about which government is in power. Don't get me wrong. I'm talking about stability. Stability means if there's usually coalition governments, they tend to be very unstable by the nature itself, and they tend to fall and collapse. But if you have a party if you have coalition government, it usually tends to be unstable and collapse. Doesn't offer political stability. Meanwhile, if you have a party sitting in majority, you can at least be guaranteed for the next 4 to 5 years there seems to be no change in power, or there's no shift in policy. Then, of course, also you can look at international trade dynamics. If your company which you're investing is in export or is into import, and what is the position of this internationally and how does it affect your company? After the macroeconomics analysis is done, we move on to the future projections. This is purely on your personal intuition. There is no real number crunching in this. There is no real looking at facts and news and figures. Is actually purely based on your intuition. After you read everything and studied everything, you finally come to saying, okay, what is the future you feel, your gut says for this company? This is what sets apart from great investors to beginners, because great investors can look at the future of the company a mile ahead. Like Anand always says, if you're able to see the ball coming at you like a football, you'll be able to hammer it for a 6. So this comes through practice, this future projection. So don't be hard on yourself when you fail in future projection. After you do all this, then you'd have to evaluate your own financial state on how much money you would like to plug into this company. How many shares do you want to plug in? How long do you want to hold on to this? And what do you think about investing into this company? This is a kind of rough layout which is me and Anand use to look at analyzing any new company that comes to our table to see if should we be investing, if should we be buying into this company. I hope you guys found this podcast interesting as always and informative. Do let me know how you like this new setup of having a little bit of background noise around me. If it made it less boring or like a drone. I do try and take your feedback too hard. So do be critical in your feedback. I don't mind. You can let me know what you feel. I will try and incorporate as much as I can in future podcasts as we go forward. Thank you again for joining us on Be Rich today. Do think about subscribing to our channel and turning on the bell notification so you'll be notified every time we come up with something nice and new for you. That being said, thank you.